Scenario 1. Which financial statement would you primarily use to evaluate a company's liquidity position? Let's imagine you're managing your finances, and you want to know if you have enough money to cover your bills at the end of the month. To do that, you'd look at what you own, cash, bank savings, and what you owe, your bills. For a company, that's what the balance sheet does. It shows how much cash or assets the company has that can be quickly turned into money to pay off debts. The balance sheet helps you determine if a company is liquid, meaning it has enough to pay its short-term obligations. The income statement, on the other hand, tells you how much money the company made over a period, but doesn't focus on its immediate ability to pay debts. Scenario 2. What does a higher current ratio indicate about a company's short-term financial health? Imagine a friend who has plenty of money in the bank to cover next month's rent and utilities. If your friend has more than enough saved up, they're in good shape, right? The current ratio works in a similar way for companies. A higher current ratio means the company has plenty of current assets, like cash or things they can quickly sell, to cover its short-term debts. It's like having extra money in the bank for any unexpected expenses. This signals that the company can easily meet its short-term obligations. Scenario 3. When analyzing profitability, which ratio is most commonly used? Imagine you invested $100 in your friend's business, and at the end of the year, they hand you $20 as a thank you for supporting them. That's a 20% return on equity, ROE. It measures how well a company is using the money from its shareholders, you, to generate profits. For every dollar of equity, how much profit is the company making? A high ROE means the company is doing well and making smart decisions with the resources shareholders have provided. Scenario 4. A company has a significantly higher gross margin than its competitors. What could this indicate? Let's say two bakeries are making cakes. One bakery is really good at keeping its costs low by buying ingredients in bulk, while the other bakery charges more for their premium, organic cakes. The first bakery is controlling its costs, and the second one has strong pricing power. This is what a higher gross margin tells us. If a company's gross margin is significantly higher than its competitors, it either has better control over its production costs, or it's able to charge higher prices. Either way, it's a sign that the company has a competitive edge in terms of costs or pricing. Scenario 5. What does a decreasing asset turnover ratio suggest about a company's operational efficiency? Imagine a farmer who has acres of land but is only using a small portion of it to grow crops. If the farmer isn't using the land effectively, they aren't generating as much income from their resources. This is what a decreasing asset turnover ratio looks like for a company. It means the company is not using its assets, like its equipment, stores, or cash, as efficiently as before to generate sales. They might have invested in new assets, but they aren't making the most of them. Scenario 6. If a company's interest coverage ratio is less than 1, what does this indicate? Imagine you have to pay $1,000 a month in rent, but your job only pays $800. You'd be in trouble, right? For a company, the interest coverage ratio shows if they're making enough money to cover their interest payments on debt. If the ratio is less than 1, it's like not having enough income to pay your rent. It's a warning that the company might be in financial distress and could struggle to make debt payments. Scenario 7. How would an increase in the quick ratio affect your analysis of a company's financial position? Let's say you have a stash of emergency cash that's big enough to cover all your bills for the next few months. The quick ratio measures how easily a company can pay its short-term debts with its most liquid assets, cash, or things that can quickly be turned into cash. If this ratio increases, it's like having an even bigger emergency fund. It means the company has stronger short-term liquidity and can easily meet its financial obligations without having to sell off long-term assets. Scenario 8. A company's debt-to-equity ratio is significantly higher than industry peers. What does this indicate? Imagine someone who's constantly borrowing money to buy things instead of using their savings. This is what a high debt-to-equity ratio looks like for a company. It means the company is relying more on borrowed money or debt than its own money or equity to finance its activities. While borrowing can help grow a company, too much debt increases financial risk. A company with a higher debt-to-equity ratio compared to its peers is more leveraged and therefore faces more risk, especially if interest rates rise or profits decline. Scenario 9. What does a declining return on assets, ROA, typically suggest? Imagine you own a store, but over the past year, even though you've invested in more shelves and stock, you're making less money from your assets. That's what a declining return on assets, ROA, looks like. It means the company is becoming less effective at using its assets, like buildings, machines, or money, to generate profit. This could signal that the company's investments aren't as profitable as they once were, which could be concerning for future performance. Scenario 10. Which financial statement would you use to assess a company's revenue and expenses over a period? Let's say you want to know how much money your business made and spent last year. You'd look at all your sales, subtract your expenses, and see what's left. That's what the income statement does for a company. It tracks revenue or sales expenses like rent and salaries and profits, which is what's left after paying the bills over a specific period. This gives a clear picture of how well the company is doing in terms of making money and controlling costs. Scenario 11. A higher inventory turnover ratio generally indicates what about a company? Imagine running a bakery that sells out of cakes every day and has to bake fresh ones constantly. A high inventory turnover ratio is like that. It means the company is selling its inventory quickly and efficiently. This is a good sign because it shows the company isn't sitting on too much unsold stock. It's moving products fast and generating sales. Companies with high inventory turnover usually have good sales or strong inventory management. Scenario 12. What could a sharp increase in accounts receivable indicate about a company? Picture a store that has been letting customers buy on credit, but more and more customers aren't paying their bills on time. If a company's accounts receivable grows rapidly, it might mean they've been offering generous credit terms, but they're not collecting payments as fast. This could be a sign that the company is at risk of not being paid for its sales, which could lead to cash flow problems in the future. Scenario 13. A company's free cash flow has been consistently negative. What might this suggest? Let's say you're running a business, but after paying your bills and making investments, you always end up with less money in the bank. If a company's free cash flow is consistently negative, it means they're spending more than they're bringing in from their core operations. This could suggest that the company is struggling to generate cash from its business, and if this continues, they might need to take on debt or sell assets to keep operating. Scenario 14. What does a high price-to-earnings (PE) ratio suggest about a company's stock? Imagine you've heard about a popular new tech company, and its stock price is much higher than other similar companies. Investors are willing to pay more for each dollar of earnings because they believe in its future growth. This is what a high PE ratio means. It shows that investors expect the company to grow quickly in the future, but it could also mean the stock is expensive and there's more risk if those growth expectations aren't met. Scenario 15. What does a company's cash flow statement help you evaluate? Let's say you're trying to figure out if your business can afford new equipment. The cash flow statement works the same way for a company. It shows how much actual cash the company is generating, especially from its day-to-day operations. Unlike the income statement, which looks at profits, the cash flow statement shows if the company is generating enough cash to pay its bills and invest in new projects. It's crucial for understanding liquidity and cash management. Scenario 16. If a company's quick ratio is 0.5, what does this indicate about its liquidity? Imagine you have $500 in the bank, but you owe $1,000 in rent next month. You're short, right? That's what a quick ratio below 1 means for a company. It might struggle to meet its short-term obligations. A quick ratio of 0.5 means the company only has half of the liquid assets needed to cover its short-term debts, which could be a warning sign of financial trouble if they can't come up with the rest quickly. Scenario 17. What does a significant increase in the debt ratio suggest about a company? Picture someone who's been taking out loan after loan, and now their debt is much higher compared to their assets. That's what a rising debt ratio looks like for a company. A higher debt ratio means the company is becoming more reliant on borrowing money, which increases financial risk. If the company can't generate enough revenue to cover those debts, it could face difficulties, especially during economic downturns or rising interest rates. Scenario 18. A company's gross profit margin has been declining. What could this indicate? Imagine you're running a store, and you notice that while you're selling the same number of products, your profits are shrinking. This could happen because your costs to produce or buy the products are going up, or maybe you've had to lower prices to compete. A declining gross profit margin shows that the company is either facing rising costs or more competitive pricing pressure, meaning they aren't making as much profit from each sale as they used to. Scenario 19. If a company has a high level of retained earnings, what does this imply about its reinvestment strategy? Think of a company that's been making profits, but instead of paying it all out in dividends to shareholders, it's keeping some of that money to reinvest in the business. High retained earnings suggest that the company is focusing on growth by using its profits to fund new projects, buy equipment, or expand. While this could mean less in immediate payouts to shareholders, it often indicates that the company is planning for long-term success. Scenario 20. What could a high dividend payout ratio indicate about a company? Imagine you're running a company and decide to pay out most of your profits as dividends to shareholders, leaving very little to reinvest in the business. A high dividend payout ratio means the company is distributing a large portion of its earnings to shareholders. While this can be great for investors looking for income, it also means the company might not have enough left over to reinvest in growth or new opportunities, potentially limiting its future expansion. Scenario 21. A high level of goodwill on the balance sheet often indicates what? Let's say a company buys another business for more than its assets are worth because it wants to take advantage of the brand name, customer loyalty, or patents. The extra amount paid is recorded as goodwill on the balance sheet. High goodwill usually means the company has made acquisitions, paying a premium above the fair value of the acquired company's assets. It represents the intangible value of the business it bought, but if the acquired business doesn't perform well, goodwill might need to be reduced, which can hurt the company's financials. Scenario 22. What does the accounts payable turnover ratio measure? Think of accounts payable as the money a company owes its suppliers for products or services. The accounts payable turnover ratio measures how quickly the company is paying off these debts. A high ratio means the company is paying its suppliers quickly, which is usually a good sign of financial health and good relationships with suppliers. A low ratio could mean the company is taking longer to pay, which might indicate cash flow problems or strained supplier relationships. Scenario 23. What is the purpose of the debt-to-equity ratio in financial analysis? Imagine you're starting a business and need to decide how much money to borrow versus how much to invest from your own savings. The debt-to-equity ratio measures the balance between money the company has borrowed, or debt, and money provided by shareholders, which we call equity. A high ratio means the company is more reliant on debt, which increases financial risk, while a lower ratio suggests the company is using more of its own or investors' money to fund operations. Scenario 24. What does a lower than average price to book or PB ratio suggest about a company? Let's say you're shopping for a car and you find one that's selling for less than similar models. A lower than average price to book ratio works the same way for a company's stock. It could mean the stock is undervalued compared to its assets. This can sometimes be a signal that the stock is a bargain, but it could also mean the market has concerns about the company's future growth or profitability. Scenario 25. What does a higher EBITDA margin suggest about a company's financial health? Imagine running a company and being able to generate a lot of profit before having to pay for interest, taxes, depreciation, or amortization. The EBITDA margin measures how efficient a company is at generating profit from its operations. A higher EBITDA margin means the company is performing well operationally, generating good profits from its core business. This is usually a positive indicator of financial health. Scenario 26. Which financial statement best shows a company's ability to generate cash from core operations? If you want to know whether a company can cover its expenses with the cash it's generating, you'd look at the cash flow statement. This statement tracks all the cash coming in and going out, showing how well the company's operations are generating enough money to pay for its day-to-day activities. It's like looking at your bank account to make sure you have enough to cover your bills and keep running your business. Scenario 27. What could a decreasing operating profit margin indicate about a company? Imagine running a store where your sales are steady, but your costs to run the store, like rent, utilities, and wages, are going up. Over time, your profits start to shrink even though your sales haven't changed. A declining operating profit margin tells the same story for a company. It shows that the company's operating expenses are increasing faster than its sales, which could be a sign of inefficiency or cost problems. Scenario 28. What does a low return on invested capital, ROIC, suggest about a company's management? Think of return on invested capital, ROIC, as a measure of how well a company is using its money to generate profits. If the ROIC is low, it means the company isn't making the most of its investments. It's like planting seeds in a field but only getting a small crop in return. A low ROIC suggests the company isn't using its capital efficiently, which could be a warning sign about the effectiveness of its management. Scenario 29. How does the times interest earned TI ratio help assess a company's financial risk? Imagine you're running a business and every month you have to pay interest on a loan. The times interest earned TI ratio tells you how easily the company can cover its interest payments with its operating income. A high TI ratio means the company earns plenty of money to cover interest expenses, which reduces financial risk. A low ratio could mean the company is struggling to pay its debts, which increases risk for both the company and its investors. Scenario 30. A high free cash flow to equity, FCFE ratio suggests what about a company? Imagine running a business, and after covering all your expenses, debts, and other obligations, you have plenty of cash left over. That's what a high free cash flow to equity, FCFE, means for a company. It shows they have strong cash availability after paying off debts and covering operational costs. This is great news for equity holders, like shareholders, because it means the company has plenty of cash to either reinvest in growth or pay out dividends.